And if we were to move to the financial markets, Rashesh Shah, it almost seems as if you put the two curves and juxtapose the curve of the stock market with that of daily death cases, they seem to be moving in tandem, completely oblivious to what is happening in the real world. Why do you think that's happening? And from the perspective of the financial markets, how did this lockdown and this wave of COVID compare with the last time?
Yeah, Rahul. See, if you see last year, the health impact was lower because we locked down very early. It was a hard lockdown. But the economic impact was very severe because it was a complete lockdown. If you see the wave 2, I think the health impact is much higher, as we have seen hospitals have been overwhelmed and all. But the economic impact has been lower because it's not a complete standstill. So part of what we are seeing from investors' point of view, they are looking across the curve. They are saying the economic impact will not be as much. Having said that, I think last time the economic impact was a lot more visible. This time it is a lot more invisible because the last time the urban areas got affected. Now a lot of economic impact has also been in the rural areas. We are seeing companies in the gold loan sector or the microfinance sectors. They are already reporting a lot of stress, build-up that is going on. The commercial vehicle financing companies, all of them. So already I think the stress is building up, but it's a lot more invisible because the larger companies are doing well. Also, there is a lot of liquidity in the system because RBI last year has pumped a lot of liquidity. The monetary policy is easing at the moment. As a result of that, the larger companies, the formal sector is doing still well because they've not been affected by a complete close down this time, as well as a lot of liquidity is finding its way to the larger companies. So what a lot of people call the K-shaped recovery, what the stock market really represents is not only the formal part of the economy, but really the top end of the formal part of the economy. The stock market ultimately is about 300 companies in the country. So since there is a lot of global liquidity, there is a lot of Indian liquidity, and a lot of that liquidity is not flowing into credit, it is flowing into assets. So it's not just the stock market. I think the real estate market is also doing well because people are not able to earn a good return by keeping their money in the bank, and there is a lot of money. But I must also add that there is a lot of liquidity, but we have seen April and May, credit growth come to a real standstill. I think April and May, when you see the credit growth for this quarter, it will be very, very dismal. And I think that is the sign to really worry about, because what is important is not liquidity, but what is important is credit flow. Okay. And credit flow to a larger part of the economy, the SMEs, the rural sector, the people, because a lot of individuals, a lot of SMEs have used up all the reserves. I mean, they used up the reserves in wave 1, but in wave 2, people have really, taken loan against the pension fund. We have seen data that people have borrowed against their EPFO, funds and all. So people have dipped into the savings, the reserves are running low, and we need to we need to really proactively ensure that people don't just withdraw and demand just collapses as we go forward.
Those are important points.